Good, let's look at the accounting entries when there was an oversubscription of shares. So the company wants to raise capital by the issuing of, let's say, 100,000 1 Rand shares. So it wants to raise 100,000 Rand with this issue of shares. Now, how many guys can be successful in this share allocation? Only 100,000 shares, because that is the maximum that can be allotted according to the authorized capital that the directors were able to issue. Now, let's assume then that we have received more applications. We have received 120,000 share applications. So obviously, we can only allot 100,000. And those guys who were unsuccessful with their applications, the company have to reimburse them. They have to send that money back. Remember what we said is in this bank account where we're going to accumulate it, the money which accompany the offers to purchase from this prospective applicants. Now, that money doesn't belong to the company. So if there was unsuccessful subscription money lying in that bank account, at the date of the allotment of the shares, it needs to be paid back to the applicants. Right, so if there were more applications than what we can actually allot, in the prospectus, they will tell you what is the method that they're going to apply in order to allot the shares. So I cannot simply go and say, well, I prefer ABC Limited as a shareholder because it's a friend of mine and he's the major shareholder of that company, so therefore we're going to allot all the shares to him. It doesn't work that way. There must be a certain formula where they say, well, let's say there is a 20% oversubscription, then every guy will only receive 4 out of 5 shares that he has applied for. So it's fair and square. Everybody is going to lose 20% of the number of shares that they've actually wanted to have. Good. Unsuccessful applications will be returned to investors plus their cash. So let's take an example. A company offered 245,000 shares at a price of 22 Rand per share and they receive applications for 300,000 shares. So they're only able to raise money equal to 245 times 22 Rand. But what they've received is now 300,000 times 22 Rand. So in this period, from where the applications has opened up to the period, the date when the applications has closed, the company has actually received 22 Rand times 300,000 shares. I had 300,000 applications, accompanied by 22 Rand per share. So in our bank account, we would have received 6.6 million. Remember, this bank account, they are not allowed to use these funds for their own purposes. Application and the allotment account of ordinary shares, 6.6 million. Now the date comes where the applications has closed and the board of directors have to allot the shares. Now obviously we have to clean out that account. So we're going to debit the application and allotment account. We're going to credit our share capital account, but only with a maximum that we can. 245,000 multiplied by 22 Rand, which gives us 5,390,000. So I can only tap to my share capital account the number of shares that I want, the actual amount that I wanted to raise, 245,000 shares at 22 Rand. The excess money needs to be paid back to the unsuccessful applicants. So I'm going to credit this bank account where I've accumulated the money on their behalf at 55,000 shares. That was the oversubscription, 300,000 less 245,000, and the amounts accompanied 22 Rand a share. So 1,210,000 needs to be paid back to the unsuccessful applicants. What happens if there's an undersubscription of shares? Now, undersubscription is shares a company, let's say, has offered 10,000 shares to the public, and now they are not 100% sure that they're going to raise all the money that they want to raise, so they go to an underwriter. And the underwriter says, don't you worry, if there is a shortfall, I will make the shortfall good. So, at a certain percentage commission of the total value of the share capital that you want to raise, I will then carry the risk of any shortfall. So let's say they're going to charge a commission of 5% of the value of the shares issued. So who's taking the risk that there is going to be an undersubscription? Not the company, because the company is going to raise the full amount in capital that they want to raise. But the underwriter carries the risk. So if there is going to be undersubscription, it's going to cost them probably a substantial lot of money. Let's say Company A offered 245,000 shares at 22 Rand per share, and now it receives applications for 200,000 shares. So obviously a shortfall of 45,000 shares. The company has made use of an underwriter at an underwriter's commission of 5%. So how much money did they actually raise? Well, you can only in actual fact raise the amount of applicants, 200,000 times 22 Rand per share. So they've only raised 4.4 million, which they took to the application and allotment account. Now the date of applications have closed. Company goes to the underwriter and says, sorry, but here is a shortfall of 45,000 shares that you have to make good. So in the first place, the underwriter has to take up that shortfall of 45,000, 245 less 200,000 at the 22 Rand. So again, they will have to pay it into this bank account. So this bank account will be debited with 990 Rand, and my application and allotment account is going to be credited with 990,000 Rand. Now we're going to allot the shares. So 4.4 million plus 990 gives me 5.39 million, and that is the value of the share capital that we wanted to raise. 245,000 shares at 22 Rand per share. Now the underwriter's commission is based on the amount that we wanted to raise. We wanted to raise 5,390,000 multiplied by 5%. i.e. 245,000 shares multiplied by 22 Rand per share multiplied by 5%. And that gives us then underwriter's commission of 269,500 and bank 269,500. Now I have a choice how to deal with underwriter's commission, and I must tell you what the accounting policy of the company is so that you know how you must deal with underwriter's commission. If I don't give you the accounting policy of the company, you can treat it in either one or two ways. Remember at year end now, there's going to be an account with a debit balance in our books. Underwriter's commission, 269,500. Is that a normal operating expense? Is it a normal activity to go willy-nilly and issue shares around every corner? No, it isn't. It's probably something that happens every 5, maybe 10 years, maybe never in a company's history. So I cannot treat that debit account as an expense account in my income statement, because that will mean that my income, my profit for the year, is really going to be total cockeyed, because I didn't have a normal operating expense of 269,500. So my one alternative is to write off this underwriter's commission against my share capital account. So how much money would I have raised? 5,390. And then I'm going to debit my share capital account with an underwriter's commission of 269,500 Rand. The other alternative is that I could have taken that underwriter's commission debit and write it off against retained earnings. So then instead of debiting share capital, I would have debited retained earnings with 269,500, and then I would have gotten rid of my debit account underwriter's commission. So in other words, what we say is, there right at the bottom, retained earnings would have been debited with a 269,500, and underwriter's commission would have been credited with 269,500. Now there's a lot of cost associated with issuing new shares. You can just think, what is the cost involved in printing a prospectus. And it's not only the printing costs. You need a lot of experts to express an opinion or to give us a report, which is then included in the prospectus. And that doesn't happen for free. It costs a lot of money in order to prepare those reports, and a lot of people needs to be paid. So therefore, share issue costs is also a very important cost, and you must ask yourself, is this a normal operating expense? No, why not? For exactly the same reason why underwriter's commission is not a normal operating expense. A company does not issue shares every day of its life. It doesn't happen even on an annual basis. It happens maybe every 5 years or 10 years, whatever the case might be. So therefore, share issue cost is also treated exactly the same as underwriter's commission. It can either be offset against the share capital account, the equity account, or it can be offset against retained earnings. So let's say the company has paid 150,000 Rand in share issue cost. I will debit share issue cost with 150,000. I will credit bank with 150,000. At the end of the year, I'm sitting with an account there with a debit balance of 150,000, of which I cannot show it as an asset. It is definitely not an asset. So in my books, a debit is either an asset or an expense. Is it a normal expense? No, it isn't. So therefore, we can either go and write it off against share capital, the capital that was actually issued. We're going to account for this cost against the proceeds on that specific shares that was issued, and then we're going to get rid of that debit account, that debit balance account in our books.